Hey guys, welcome to another episode of Groww Academy. Now in the last module, we learned everything from analyzing a stock and industry and also some major red flags that we should be aware of. Now in this module, we will understand the link between macroeconomics and the impact on the stock market. Now broadly, we will be talking about three factors that will have a big impact on the overall working of our economy and the markets. Now these three topics are often discussed and debated but rarely understood in detail. Now these three topics are interest rate, GDP and inflation. Now, we will also learn how these factors have a direct or indirect impact on the stock market. So in today's episode, we're going to talk about interest rates. Now, are you as excited as I am? Because without further ado, I want to start learning what interest rates are and how it affects the entire stock market. So what are interest rates? Now, are we talking about interest rates which banks offer on our savings accounts or fixed deposits? No, not exactly. But yes, all of it is connected with each other in some way. So let's start from the extreme basics. Now basically, interest rates are a mechanism by which the central bank of the country, which is the RBI, Reserve Bank of India, takes actions to influence the economy of the country. Now as we all know, the RBI is responsible for the monetary policy of India. The primary objective of monetary policy of RBI is to maintain the price stability and drive sustainable growth for the economy. So basically, the RBI sets benchmark or policy rates, which are the rates at which the scheduled banks in India borrow or deposit funds with the RBI. Now, let me explain this in simple terms. Suppose a farmer produces some fruits. Eventually, these fruits will reach end customers like us, passing through various channels such as a wholesaler and a retail seller. Now, think of RBI as the farmer who is the originator of money or the fruit in this case. But for producing these fruits, the farmer needs raw materials first. And the price of these raw materials will also decide the price of the fruit subsequently, correct? So, think of these raw materials as benchmark interest rates we are talking about. Whatever benchmark or policy interest rates are set by the RBI, they are passed down to other banks, and through those banks, they are ultimately passed down to end customers like me and you. Now, also we should also understand that intermediary banks between the farmer and the end customer adds their commission on top of this, and the farmer selling their price. This means this happens at each level in the financial system too. Now, the financial intermediaries, that is banks and financial institutions, also borrow money from the RBI. So at whatever rate the RBI lends to them, they will add on top of that original benchmark and pass it down to the customer. So everyone's charging a small amount of commission there. Now, any changes in the benchmark interest rate will cause changes in the entire interest value chain in the economy that is dependent on that benchmark rate. So are you getting the point? Like, just by changing the price of raw material, that is the interest rate, the RBI can control the entire economy. Now, given the critical nature of benchmark rates and the widespread impact of changes in them, RBI makes these changes in interest rate only by 25 BPS at a time, right? Or 25 bips at a time. Now, let me introduce to you the benchmark interest rates about whom we've been talking about so far. Now, the RBI has two main policy rates which determine the entire country's interest rates, and they are repo rate, right, and reverse repo rate. Now, the first one is called repo rate. Now, this is the short-term lending rate charged from scheduled banks, maximum 90 days. Now, in simple terms, this is the rate at which commercial banks borrow money from the RBI. Then we have reverse repo rate. Now, this is the short-term deposit rate offered to the scheduled banks, max 90 days again. And in simple terms, this is the rate at which the RBI borrows money from these banks. Now, apart from adjusting the repo rate and the reverse repo rate, the RBI also carries out something called as open market operations or OMOs. Now, in the case of open market operations, the RBI carries out the purchase and sale of government securities on the center's behalf. Now, you would think how open market operations actually affect the interest rates, which is a valid question. So basically, whenever there is an inflationary situation, RBI would want to absorb the excess money from the market to control it. Now, in order to do so, the RBI sells government securities in the open market, which results in a drop in the bond rates while increasing the interest rates. Similarly, in a recessionary trend, RBI wants to boost money supply in the market. So it buys securities, increasing the money supply while reducing the interest rate. Now, I hope you've got a fair idea of how RBI handles interest rates by different means such as policy rates, repo rates, reverse repo rates, and also by carrying out open market operations. Now, one more thing to note is that interest rates are also affected by expectations of inflation. Now, let me explain this also with an example. Suppose the current inflation rate is 5% and the interest rates being offered are 6 to 7%. So why do we invest in such instruments which can barely beat inflation, right? But the low interest rate in bond market here suggests that investors expect the inflation rate to be slightly lower than 5%. Now, similarly, when the expected inflation rate increases or decreases, it has an impact on the bond market as well as resulting in rise and drop in prices of the interest rates. So, till now, we have understood how interest rates are impacted either through actions of RBI or through actions of inflation. Now let's understand the role of interest rates in an economy. The basic function of interest rate actions is to accelerate or decelerate the money activity in the economy. But you must be wondering, how does all this actually work? So let me make it slightly more clear for you. Now suppose the GDP of our country has been declining and inflation is low. Then the RBI will lower the interest rate to accelerate money activity in the country. Now if the interest rates are cut down, then it will make loans cheaper for all the borrowers in the system as it gets reflected in the interest rates everywhere. Hence, easy access to loans is expected to increase in more and more people taking loans for business activities and other purpose, which will drive up consumption and drive up investment. Now, consequently, if you look at it, a rise in overall money supply in the system will also be seen as lead to higher GDP and will lead to higher inflation. Similarly, when the economy is overheated, right, inflation is rising too much faster than expected, and the economy and industry sectors are functioning near 100% capacity, then in such cases, the RBI increases the interest rates to slow down and cool the economy. So it's a very up and down scenario. Now, this is because an interest rate hike makes loans more expensive. So why do we borrow money on a higher interest rate? Hence, this move discourages borrowing and incentivizes savings, right? Now, if people save more, what will happen? Automatically, there will be a decline in consumption and investment. This will bring the economy to sustainable levels and also help curb inflation by decreasing the money supply in the system. Now, hope all this is very clear on how interest rates work, and they play a massive role in the economy. Now, let's see the relationship between interest rates and the stock market. Now, let's look at the impact. The immediate impact of changes in interest rate is straightforward. Whenever rate cuts happen, it generally results in a rise in the stock market participation and sentiment. Similarly, when rate hikes happen, most expected to result in a fall in market sentiment. Now, here is an example of how it changes interest rate affect market prices, right? Now, it is widely expected that there will be a rate hike in November 2021 for some reason. Now, the RBI announces that it will not be doing any kind of hike in November 2021. Then this will act as a positive sentiment for the markets, and thus the market will go up, right, if they don't increase this. Now, hope you understood how interest rates have a direct relation to the stock market. So now we know everything about interest rates and their impact on the economy and the stock market. Now in the next episode, we will talk about GDP in detail, what is GDP and what is its impact on the stock market. So I hope you guys like today's episode. I'm going to see you guys in the next one.